Alright, what's going guys? Jeff here back again with another video. So today, well right now, it's Wednesday, about 4 a.m. or so. And I am doing this video because I promised you guys that we're getting this FAANG video out of the way. By the way, there won't be anything on screen. Just pardon my nosebleed at the moment. Suddenly, not sure it's because of the stress or whatever it is. By the way, there won't be anything on screen. You can watch this as podcast style video. This should be about a 15-minute video, I hope. I'm not sure how long this will be. But okay, anyway, for people who do not know what FAANG is, FAANG is the FAANG, which is stands for your Facebook, Amazon, Apple, Netflix, Google, aka Alphabet. This is the 5 biggest tech companies that was being established at this time. Of course, in the near future, FB would be changed to MERS, which is Meta Platforms, or aka Metaverse, according to the ticker symbol itself. And we might be getting MANG, but of course, there is also a possibility that for Facebook, they might actually be getting kicked out of FAANG. Personally speaking, I think that we might actually take out Facebook and put in Tesla instead, or you can get FAANG. But let's talk about why. Or well, not why, but what actually happened in the past 2 weeks or so, what actually transpired during the whole earnings season for all these tech companies. So the 5 companies that, well, more what we're talking about right now, the FAANG, that the earnings report that we actually really care about is the start of where this actually began with, which was Netflix. And when Netflix reported their earnings, it was actually an alright earning, but afterwards it was followed by a very bad guidance, where they actually reported lesser growth and also a drop in subscriber growth in the next quarter. So this was basically foreshadowing a possible recession-esque style decline in the tech industry. That kind of set the tone for the entire tech industry, because Netflix was one of the first few companies to do their earnings call, and they actually gave bad guidance. The second company to do so was Apple. So Apple basically saved the entire market because Apple reported good earnings amidst of course, the current pandemic and also the supply chain shortages that we're actually going through as the global supply chain is being affected at the moment. And Apple actually said that, they actually went above and beyond, and only iPads was the only one that was being affected. Well, not really affected, but iPads was the only one that the sales revenue didn't actually hit as expected. Everything else was big. But Apple was actually very smart about it, because Apple did not provide guidance. And because the fact that Apple did not provide guidance, we didn't really necessarily see Apple actually go to the moon. Because if they're not going to be giving us guidance, we don't know what Apple is supposedly looking for. And if we don't know what Apple is going to be looking for, we don't really have a target for the next quarter. So how guidance actually work and why guidance is so important for this quarter is because in quarter 4, people don't really care about your earnings, especially what we saw in Netflix. When Netflix reported earnings, pretty good earnings, well, decent earnings, with a bad guidance, they dropped 26% or something ridiculous, or even 30% or something crazy. And for Apple, where they have an all beat on every matrix possible other than iPad's revenue, and they only missed it by, I think, a few $1 million, okay? And they barely increased 5%. Like, they maybe got a 4% day, and maybe another 1 or 2% day the day after. And that was pretty bad for Apple, for what it's worth, because, if you actually got such a good earnings, we expect something a lot better. So why does good earnings not get rewarded, but bad earnings / guidance get punished to that extent? That's kind of the question for this entire Q4 earnings seasons. So it actually comes down to guidance for the most part of it, because how it works is that when a company gives out earnings and they give out guidance, the moment a company give out guidance, we kind of have a set target for the next quarter. When we have a set target for the next quarter, it's a lot easier for us to actually look at the next quarter, and with all the numbers that's actually being provided by the company, we can actually see if it is a beat or a miss on estimates according to the company itself. And that's how we actually see if did they actually do better than they expected on their own, or did they actually do worse than what they expected on their own, which is why that is very important. But what Apple did was they reported good earnings, but they did not give us any sort of guidance, and they basically just punted on the guidance and just said, like, the future is uncertain. We're not sure about the supply chain constraints. We're not sure about what will happen in this Omicron pandemic that's currently going on. And because of that, Apple is unwilling to give us a guidance for the next quarter, which is the quarter one of 2022. And because of that, Apple did not give us any guidance, and which is why we see good earnings not getting, not really getting appreciated as much. Which is why you are not being well rewarded for a good earnings, and you get very, very badly punished for a bad earnings. So afterwards, we actually got Facebook reporting, which was horrible because Facebook missed on every single thing possible. Okay, they missed on Metaverse, they missed on the Instagram and Facebook platform, they missed on subscriber count, they missed on growth, they missed on guidance, everything possible. They miss. And because of that, Facebook basically dropped 30% or so, or something ridiculous along that line. And even after that, they kind of dropped a few, I think 5 or 6% after that again, a few days after, and it was quite bad. And it's simply because they got bad earnings, bad guidance, and they are just gonna get 2 times the punishment by the entire market, and people are just gonna take this chance to really beat up on Facebook themselves. Afterwards, we got earnings from Google Alphabet, where we actually saw a beat in earnings on Google, which was very, very good. I was very, very pleasantly surprised because we saw a beat in Google. On top of the revenue beat, YouTube ads was also up. I'm almost certain that we actually got a fairly decent beat on a lot of metrics for Google. And on top of that, we even got a additional announcement, which would be a 20-to-1 Google stock split, which is very, very important for the entire stocks market because, of course, this doesn't exactly change how we would view the entire stocks market, because if Google perform a 20-to-1 stock split, basically there's still going to be the same market cap. By right, we're not supposed to see Google as any sort of different company, but historically, when we see Apple do a stock split, we see Apple go up higher. We see Tesla do a stock split, we see Tesla go higher. And this always happens because what happens during a stock split is that you're actually lowering the barrier of entry for any sort of retail investor or institutional investor who want to get in on the action for the company. And this kind of encourages them to get in a lot easier. So right now, Google, as of this recording right now, is $2,750. Okay, and if we actually do it post-split, they would be somewhere in the $150 range or so. And that would strongly encourage someone like myself and you and I, retail investors, who can basically just get into Google stock because it just makes sense for us to actually get into Google. If I want to get into Google, okay, I might have $3,000 to invest. And I don't want to buy one whole Google stock right now because that's going to set me back $2,750. And I'm just going to be left with $250, I'm not going to be able to do much with it. So what I am able to do is that if we do get a split, I can actually do a 50-50, buying 50% of Google and 50% of Apple. That way I can kind of do a lot more diversifying of my portfolio if I want to as a retail investor myself. And because of that, I think the stock split is going to really help the market cap. simply because of the the lowering of the barrier of entry for all these other companies to really get in on. Which is why I'm very, very happy about Google doing that. Which is also why I also bought Google. One of the big contributing factor and one of the main pushes of why I actually did that was also because of the 20-to-1 stock split. And for Google, same thing as Apple, they did not really give us any sort of guidance, which is why Google basically went up by like 10%, and afterwards they kind of just lost its steam, and it is about like maybe 3%, 4% above the price before its earning, which is why, like I said before, without guidance, it is confusing the investors. The investors do not know what are they supposed to do. Okay, we are uncertain of what Google is expecting for the next quarter. Are we expecting bad ads revenue for Google? Are we expecting bad Google ads revenue for quarter one of 2022? Which is why guidance is super important. And if such a big company is not really providing us guidance, it's also possibly foreshadowing that they are possibly going to miss a lot of metrics. And that's why people are kind of, walking on eggshells. And then finally, last but not least, we got Amazon reporting their earnings. And Amazon surprisingly gave us the worst earnings possible. They missed on every single stop of the way, from revenues all the way to guidance. However, there's only one matrix that they actually beat on, okay? Which this single beat was enough for them to actually gain 13% after getting the earnings. And the beat was on the EPS, the diluted earnings per share. And the way they did it, it's a little bit scummy, okay? I have to admit, it's a little bit scummy, okay? But how they actually did it was that because they were able to, report their shares in Rivian into their EPS, they can basically just say that, because of our stake in Rivian, the EPS for Amazon is currently at this figure. And we were actually estimated to hit an EPS of $3.88. Okay, they reported $27.80 or something stupid. Okay, that's easily 7 to 8 times of what we were actually expected, and which is why, because of this 7 to 8 times earnings per share as expected, shot Amazon through the sky. And this, okay, honestly speaking, I'm kind of happy that they did that as well, because what Amazon did over here, where we actually see the 13%, 14%, or 15% spike after the earnings report, this action actually saved the market, because the market started to become a little bit more euphoric. People start to be like, okay, you know what, I might want to be a little bit more risk on. I might want to get into Amazon a little bit more, or I might want to get into their payment partner, which is Affirm, or I want to get into other chips manufacturer, because if Amazon is doing well, chips manufacturer might be doing well as well. And because of this entire way people are actually thinking from how the FAANG is being operated right now, they are thinking, oh man, if Amazon is earning so much money, what about the smaller companies that's around FAANG that is also getting all this good stuff? We are expecting them to do well as well. That's kind of how the mindset works for investing, right? And because of that, when Amazon actually gave us this EPS, they gave us this botched idea that Amazon is doing really, really well. But when you actually dissect the numbers into it, if we should take away Rivian from the entire earnings, if we actually just completely exclude Rivian, the EPS for Amazon was about $5 or so, which is a normal beat. It's just a beat on EPS, and that's about it. Of course, I bet it's not a miss on EPS, which is very, very big, okay? Because if they do miss on EPS, Amazon would go to, okay, I won't say go to nothing, but they're gonna follow a Facebook level kind of drop, okay? But because of this EPS, they kind of saved the earnings season for themselves, and also at the same time they saved the entire market, which is why I'm also grateful to a certain extent for what Amazon did over there. And for guidance wise, like I said, Amazon didn't really give us any sort of guidance. So now this kind of begs the question, which is like, since quarter four is almost over, of course, right now I'm still waiting for a few more earnings report, but quarter four is almost over, and since quarter four is almost over, we kind of want to look into quarter one of 2022 and what I kind of expect from quarter one of 2022. Similarly, I think that it's going to be it's going to be the same song. Okay, investing is kind of boring. It's always going to be the same thing. Okay, the same steps, the same punches. And how it's going to work is that for now, people are still going to be risk off rather than risk on. Okay, so that means that companies who are still not profitable are going to get destroyed. Okay, if you're not profitable, you are going to get destroyed. Retail investors, and maybe retail investors is different because retail investors are so diverse. But institutional investors, on the other hand, they hate non-profitable companies right now. So if you are going to be investing in the non-profitable company, you better hope that this is going to be an investment for the next 5 years, 10 years, 20 years. Because if you are going to be investing into a non-profitable company right now in this current day and age, that sounds very very boomerish of me. In this current this current month, okay, let's just say this month, since it's gonna shift very quickly anyway. So in this month, if you want to be investing into a company that's non-profitable, then you better hope that it's going to be for a long-term period of time, and hopefully you're going to see some sort of profit in the near future, because institutional investors are not going to be touching those non-profitable companies with a 10-foot pole, without doubt. Okay, yeah, institutional investors are more interested in those profitable companies, really disrupting industry, and also at the same time, if they're disrupting industry, they also need to be profitable to a certain extent. Which is what if, let's just say, we have another early days of Tesla, like let's say like a 2016 Tesla come out right now. They're not going to be well liked either. Okay, because you're not profitable, you don't have a proper business model. Maybe you have a working prototype, but you have not really proved yourself, and because of that, the market is not going to like you. Okay, as compared to what Tesla is today, of course, people love Tesla, people are raving about Tesla, people are buying the name of Tesla, and Tesla is a great company because they actually solved a lot of problems. They're disrupting a huge industry. Okay, so right now, if a company is trying to disrupt an industry, but they're not profitable, they don't really have a proper business model, they might have a prototype. Institutional investors are still not going to look at it. However much retail investors want to rave about how good this is, they want to show about how good this company is, want to get out of it to invest in it. It's not enough money by the retail investors. Okay, we're just not that strong. Investors such as all your hedge funds, they are the one with the big money. Retail investors like you and I, how much money how much money can we pump into a company? Of course, you can talk about AMC, you can talk about GME, you can talk about Microvision, you can talk about Nano Dimension, whatever, all those pumps company that happened back in 2021 in January and February period. Fair enough. Of course, we're talking about the whole retail movement where we're going against the hedge funds. But right now, it's not going to be so simple. And I think that's kind of the concern that I have about the market. And I feel that in order for us to really see this sort of shift, which should be happening most probably in quarter one, quarter two, quarter three of 2022, which should be a more cautious moving of all this sort of earnings and guidance. I think guidance is going to be starting from this quarter onwards, of course. People will be looking at it a lot more sternly. People will be a lot more critical on the guidance itself. Especially for a non-profitable company or companies that are actually meeting up with a roadblock up ahead. Those are the companies where the guidance will be really looking through with a fine-tooth comb, where we want to make sure that the company is actually healthy enough for them to actually go through another few more quarters. And that's kind of where the concern for all the companies actually come in, because for guidance, a lot of time, people basically just companies just give out a very basic outlook, like, okay, we're expecting 20% growth, and maybe for the subscriber growth, we might be getting a 10%. Done, full stop, done. And that's not much for us to really run off on that. And then analysts from other places will kind of just form their own speculation around it, and then they will create this sort of expectation chart for what they actually expect of the company to really do for the next earnings. And of course, a lot of analysts kind of do it, and then we kind of just find one that we all follow by the consensus of. And yeah, I think that for quarter one of 2022, I would imagine that we'll be going through the same quarter. So we should not be so overly obsessed over earnings per se. So even if you think that a company is doing very, very well in terms of earnings, do also take note of the future forthcoming of the company. So for example, if you're interested in NVIDIA and you think that NVIDIA is going to have a kick-ass quarter one in 2022, sure, I personally believe so as well. But the thing is that if we do see the supply chain countries getting even worse in quarter two, and so what if we have so much demand, but there's not enough supply to really feed to all this demand? So if supply chain is going to get worse and worse in quarter two and quarter three and the following quarters to come, if this actually continues to happen, the guidance for quarter one for NVIDIA, they might actually say quarter two, it might be a lot worse because supply chains are actually closing in. We might not be able to actually hit the sales that we actually want, or we might be increasing prices. And due to the way that we're going to be increasing prices, we might be earning slightly more, but at the same time, we're not actually doing more volume. And because of that, the growth of the company is not going to be as much due to the demand still being so high. And of course, this actually creates more inflation. But of course, we're talking about this made-up scenario of if this actually happens. And because if that actually happens, then this would be a little bit more worrying for an investor like myself. I would kind of be thinking okay, if that's the case, then in quarter one, if I actually see good earnings from NVIDIA, I might actually just sell on the good earnings. And then I will see what happens on quarter two. If it actually goes down, I might buy in on that dip and so-called lowering my cost basis on NVIDIA. If it does go up, then I'm just going to buy in on the pump. Even if I'm going to be losing out on the 5, 8%, 10% or whatever, I'm okay with losing that 10% because the whole point is because I'm worried about what's going to be happening in quarter two, because their own guidance, they're actually worried about it themselves. So that's kind of how I think the entire earnings for the next few quarters is going to be going. So yeah, that's kind of like what's my thought on the whole entire FAANG situation. And of course, something that I would like to try to do a prediction on as well, which will be these 5 companies will be very, very aggressive on M&As, merger and acquisition, with a lot of companies in the following quarters. I feel that in order for them to stay relevant or even stay in this current 5 in this chronological order for the biggest tech companies in the United States, they really need to cover a lot of ground, which is why such as Peloton, they're actually saying that Amazon is thinking about having an acquisition of Peloton, which is quite interesting. Of course, there are some people who are talking about Google, maybe also getting into the wellness, fitness sort of skill with acquiring of Peloton. Of course, Nike, Lululemon, Adidas, all of them are basically also in the talks of so-called trying to get a value acquisition on the Peloton as well. But of course, all of these are just rumors and we're not very, very sure. But I think with the sudden trend of all this acquisition is happening, such as Microsoft acquiring Activision, Sony acquiring Bungie. We have like the whole SoftBank arm deal, Frontier with Spirit Airlines, and then now with Peloton, possibly getting an acquisition. We do not know. So yeah, I think that for these 5 companies, there is a very, very good chance that we might see some M&As happening in the near futures. And of course, when all this M&A do happen, there is a good chance that they will actually increase the price of this company. So these are just some of the news that you might want to keep a lookout. Just keep a lookout for. These are so-called the potential catalysts to actually bring all these prices down. Of course, this is just a video for people who actually really care about the FAANG. But of course, if you are more interested in the smaller caps, personally, I am more interested in the smaller caps as well. So if you're more interested in smaller caps, of course, this wouldn't be that big of an issue. But I would also tell you the same thing. which should be that earnings and guidance will be the same thing for smaller caps as well. Non-profitable smaller caps, you are gonna get destroyed. Okay, but anyway, that's all I have for this video. I don't want to ramble on for too long. Okay, it's 25 minutes. And yeah, I want to go ahead and clear this nosebleed of mine. And also, the earnings report should be coming out in another 30 minutes or so. So I want to go through the market myself a little bit before the market closing. So yeah, anyway, thank you guys for watching, and I'll see you guys tomorrow for the news, daily news. All right, see you guys tomorrow. Bye.